Hello, everyone. Thanks for joining and welcome back to Wall Street Bullion. Our guest today is Steve Hanke. Steve is a professor of applied economics at Johns Hopkins University and a distinguished senior scholar at the Mises Institute. He also served on President Reagan's Council of Economics Advisors. He is the author of two recent books that came out, Capital Interest and Waiting and Making Money Work. Thank you so much for joining us, Steve.
Great. Glad to be with you, Ivan.
Yeah, glad to have you on. I wanted to bring you on to to you about everything that's happening right now in the precious metals space, in the financial markets. First, though, let's start off with gold and silver. We're seeing gold right now. The price is about 35.86 US, $41 for silver. It's 13-year high, a new high, all-time highs for silver. What do you think is happening right now in the precious metals? Are we pricing out lower interest rates? What are your thoughts?
Well, first of all, we've been in a pretty long-term bull market. Uh, so the last little spurt, I think, has a lot to do with what's going on in the geopolitical scene. And I think the meeting last weekend in China, in which you had, shall we say, the big phalanx, Russia, China, and India joining hands, uh, was a big deal actually, and a lot of it comes into the pushback against the United States. The United States is perceived as being a bully, and the reason they're perceived as being a bully is the fact that they are a bully.
Right.
And when I say that, I'm talking about number one, sanctions. We have one layer of sanctions after another going on a variety of countries. Anything the United States doesn't like, they just sanction it. Of
Right.
course, Russia has most of them. So that's a weapon of war, and they that actually weaponizes the whole dollar financial system. And so people want to get away from it and go to an alternative. And we know what one alternative happens to be, and that's gold big time. The second thing is we have tariffs. And this tariff story remains completely unsettled, shall we say. And like sanctions, tariffs are a weapon of war, a weapon of commercial warfare. So if somebody's shooting at you in a real war, of course, you know what's going on. If they're shooting at you in a sanctions, that also gets your attention, shall we say, and you start looking for other alternatives. So that's basically, I think, the last couple of weeks, that's what's going on.
So, do you think Trump and the United States is making a terrible mistake with how they're handling the situation with India, Russia, and China? Do you think they made a poor decision with how they're handling tariffs? What are your thoughts, Steve?
Yeah, they're all. I'm a classical liberal economist. I'm a free trader. I'm against all sanctions, all tariffs, all quotas, all non-tariff barriers. I want no interference with voluntary trade and private transactions
Right.
among among individuals. So that's the principle. But then, if I look at the empirical evidence, you always have to say, well, do the data support your theory or your ideas? And it definitely does. And that's why you find almost no economist in the world, whether they're right, left, center, whatever they are, they're against tariffs. Sanctions are in kind of another category because sanctions are viewed as actually a national defense or security kind of issue. So
Right.
it's a little bit different. I view them exactly like tariffs. My view is that tariffs and sanctions are one and the same thing. But the rationale for sanctions is a little bit different than the rationale for tariffs. And that's why you don't have, 99.9% of all professional economists would be against tariffs or quotas or non-tariff barriers. That percentage goes way down if you're talking about sanctions.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used. Is just absolutely insane. Monetary metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
What about, because you served on President Reagan's Council of Economic Advisors, comparing this administration to Ronald Reagan's administration, what are the things that Trump can be doing better compared to when you were on the the Council of Economic Advisors? And what did Reagan do different that maybe that was better than Trump's in these certain situations?
Well, for one thing, Reagan had a very clear manifesto when he was elected in 1980, and that was all free market. So get the government out, deregulate things, free trade, and when we compare that to kind of this ad hoc interventionist approach of Trump, of course, it's just night and day, because Trump not only is against free trade, he's against free markets. We just had them intervening and taking over 10% of Intel shares. NVIDIA, we have 15% of those profits will be taken away if they export things to China. So there are all kinds of micro interventions in industry and business that are going on right now, which
Right.
would have been a no-no with Reagan. Now, Reagan, as it turns out, on the trade front, we did deregulate, by the way, and the general scene became much more free market in the United States under Reagan in these two administrations. The one picture that's kind of mixed is with trade. Reagan was a free trader, but a lot of Republicans, as well as Democrats, were interventionist. And remember, at the time, the enemy was supposedly Japan. It wasn't China. It was Japan. And we had all kinds of interventions, tariffs and quotas being imposed, primarily targeted on Japan. And those were just political deals that Reagan kind of held his nose and signed off on, but he didn't have the votes to do anything other than what he did. But he was against them. Whereas Trump is actually for them. I mean, Trump advertises himself as the tariff man.
Hello, my fellow silver and gold stacker. I just wanted to say thank you so much for watching the channel. Subscribe, please like the video, and also hit the notification bell. Keep
Tariff
stacking.
man.
Right. Steve, what would you, if you were able to speak to Trump and you were on his economic council and you were advising him, what would you, how could you convince him or, speak a little sense into him to say, hey, we need to go straight to a free market and you need to get rid of these tariffs? What would you say to him to make him change his mind?
Well, number one, I don't think he's going to change his mind. So it'd be kind of a futile exercise, because
Right.
he's latched onto this and been on it for a long time. The economics are as follows, and that is, Trump thinks that trade deficits are bad and trade deficits are caused by foreigners. In fact, trade deficits happen to be good because what do they say? They say Americans are able to consume more than they produce. And they've been able to do that since 1974. And they've been they're easy to finance for the United States because of the US dollar. Everybody wants to get into US dollar denominated assets. So the money just keeps flowing in to finance the trade deficit and allow Americans to actually spend more than the GDP. In other words, if you look at the identity, consumption plus investment plus government spending, that number is greater than the GDP in the United States. And the gap is filled by what? A trade deficit.
Right.
And it's easy to finance. So the point is the trade deficits, in fact, are good in the United States, and they are caused by Americans, not by foreigners. It's the Americans spending more than they produce that creates the trade deficit in the first place. It's not foreigners. So that would be the first lesson, and the second lesson, of course, there are a lot of lessons in this, but the Trump administration advertises that foreigners pay the tariffs. Well, that's not true. If I'm importing something into the United States, it comes into the customs office, and the U.S. importer, pay,
Right.
or I don't get the goods. The foreigner doesn't pay.
Yeah, it's another tax on the Americans. The more you, because everything will just be raised in price.
Right. It's basically a sales tax on imported goods coming into the United States. All these tariffs are. So it's kind of like a national sales tax or a VAT tax.
Yeah, that's not good at all. What would you say about the interest rates that, a lot of people are talking about, they're gonna cut either 25 basis points or 50 basis points for the interest rates, but still inflation is still at worrying levels. Do you think we're gonna make the same mistakes in the 70s as Volcker did and they cut interest rates too early? What are your thoughts?
Well, now remember, it wasn't Volcker; it was Miller, the
Hmm.
governor of the chairman of the Federal Reserve before Volcker. Volcker increased the interest rates and squeezed. He basically squeezed the money supply, and that cut the inflation rate down, killed inflation. It also, unfortunately, he squeezed a little too hard, and we had two recessions
Hmm.
in Reagan's first term,
Wow.
1980 to 1984. We actually incurred two recessions, but the inflation did get killed.
Right.
So and at that time, remember the big story was we had a bull market in bonds that lasted until what it only stopped like 2 years ago, a year and a half ago.
Right.
So the longest bull market in bonds was really kicked off when Volcker smashed inflation. We had, remember, the late 70s, we had stagflation in the United States. The economy wasn't growing and we had high rates of inflation. Reagan and Volcker turned all of that around. We started growing with the deregulation and more free markets with Reagan, and the inflation got killed with Volcker being chairman of the Fed. But the main thing, everybody's focusing on the interest rate, the Fed funds rate, which is an overnight interest rate. But the key thing is what's going on with the money supply, and the money supply actually is growing at a very slow rate. It's
Mm.
it's growing, 4.7% year over year. Hanke's golden growth rate, or rate consistent with hitting a 2% inflation target, is about a little over 6%. So for the last since the April of 2022, the money supply contracted, and now it's starting to grow a little bit. And the stock of money measured by M2 is only just a little higher than it was in April of 2022 now. So whenever we have had these kinds of contractions and anemic money supply growth, which has only happened 4 times since the Fed was founded in 1913, we've always had recessions. Or
Right.
in one case, we had the Great Depression, 1929 to 1933. The money supply got squeezed and fell by 37%.
Wow. How did we get out of the Great Depression?
Well, it very slowly, because first of all, we had the money supply collapsing, point number one. And then in 1930, we had the Smoot-Hawley tariffs come in, and the tariff level is about where it is now with Trump. By the way,
Wow.
it's only about a it was only about a percentage point higher than that. Got an interruption there.
No, that's okay. That's okay.
So at any rate, it's kind of a 1-2 punch. Now yesterday we had this jobs report in the United States, very weak, by the way, which I anticipated because of the anemic money supply growth leads eventually to a slowdown in the economy, if not a recession. And that's what we're seeing right now. And on top of it, we have all this tariff weight. And as we said, the tariffs are really like a sales tax. You put a sales tax on something and it slows down. So you kind of, and there's a lot of uncertainty about the tariffs because we don't know if Trump's going to keep them at the same levels, whether he's going to renegotiate, change. No one exactly knows from one day to the next what he's going to do with them.
Right.
So money supply slowing down leads to a slowdown in the economy. And then you throw in this tariff thing, which actually is essentially at the same average effective rate as we had with the Smoot-Hawley tariff of 1930. So that's a 1-2 punch, a negative 1-2 punch.
Right. Well, Steve, what before you go, what's concerning you, I guess right now, whether it's anything that's on your mind or you're looking at, whether it's geopolitically, financially in the markets, whether it's whatever this administration, what's concerning you that that could tip us over the iceberg and say, this is it, we're heading for a recession or whatever it is.
Well, one thing I just went through the money supply and the tariff aspect that's kind of a short term thing.
Right.
But what's most concerning is the fact that most of the markets are, at least the equity markets, are really in what I measure as bubble territory. So they're overhyped, overpriced, very expensive, and ready to take a hit. The problem is we don't know when that's going to occur.
Right.
Excuse me.
Bless. Steve, I want to thank you so much for coming down. It's such a huge pleasure for you coming to speak to the whole community. Everyone watching this, I'm going to put the links in the description below for all of Steve's links. Steve, where can people find you? Where can they follow your work?
On X is probably the easiest thing. It's just at Steve_Hanke. And one thing to keep in mind especially for your viewers, that gold usually does well going into a recession.
Yeah, so this is going to be, but it's sad too because I know as much as we want higher gold prices, it's still, the higher they go, it's going to hurt a lot of people at the same time. It's not a good state of the world, but of course we want higher prices, but I guess it's a silver-edged sword there.
Yeah, if you're a gold bull, you want to see them going up.
Yeah, no, absolutely. And we want to see that.
Okay.
Well, Steve, thank you so much for joining us. Really appreciate it. Yeah, it's a wealth of knowledge every time you come down, and we learn so much. So yeah, we want to thank you so much.
Thank you, Ivan. Good to be with you. Have a great weekend.
You too. Talk to you soon.
Okay, thank you.